tremendously excited to welcome my guest for today is Nick Timiraos, the Chief Economics Correspondent for the Wall Street Journal. He's the author of $1 Trillion Triage, and he's reporting on the economy, but in particular, the Federal Reserve is some of the most value reporting in the world. Nick, I want to, we're recording this the morning of July 26th, so the FOMC meeting has started. Tomorrow at 2 p.m. and at 2:30, we're going to get the results. Likely, it is the 75 basis point hike, the triple, not the quadruple that was briefly expected by the market. We're going to get into all of that. But first, I want to ask a question, which is, why is the Federal Reserve so keen on letting the market know what the rate hike is going to be? Let's say the actual Fed funds rate is going to be 50 on tomorrow. If the market's pricing in 75, that would worry the Fed, and the Fed would, put out some speakers and sort of let the market know that, hey, actually it's going to be 50. Why is the Fed so keen on not surprising the market?
Well, that's a good question, Jack. It's great to be back on your show. I did an interview in mid-May with Chair Powell, a virtual interview here in New York, and I asked him that because at the time, the Fed had been guiding the public to expect 50 basis point increases at the June and July meetings. That's what Powell had come out at the May meeting and said. And the question I posed was, why not just strip the Band-Aid off and do 100 at your next meeting? And his answer, and we posted a transcript of this, so you can look for it. It's at the Future of Everything Festival. And his answer was, we like to work through market expectations. And the reason the Fed has done that this year is that they, to the extent that they felt like they were behind the curve back in March when they were lifting off, right? They were still at zero in March. So guidance has actually allowed them to tighten ahead of actual rate increases. That's interesting. I have a story today about, the Fed first pioneered guidance about 20 years ago. Ben Bernanke said he was trying to convince his colleagues, he was a governor then, and he was trying to convince them that if you actually get the market to do some of your work for you, then you make monetary policy more effective. He said that, monetary policy is a cooperative game. Ambiguity has its uses in poker, for example, but you actually want the market to try to row alongside you here. Now, forward guidance, of course, was more common, and it was really pioneered by then Chair Bernanke years later when the Fed had interest rates pinned near zero. And so it was a way to try to, squeeze a little more juice out of the fruit when you didn't want to cut rates below zero because the Fed doesn't want to have negative rates. So guidance was really something that was used, beginning a decade ago. You had the summary of economic projections and the dot plot. And this was supposed to be a way to sort of guide markets to understand how your reaction function was changing, the way that you would interpret incoming data. So what's been different about this cycle this year is that Jay Powell has actually used guidance to tighten policy. The Fed actually began, if you listen to what they've been saying for the past few months, they're pointing to the 2-year, right? And they're saying, well, look, actually, technically they started to tighten policy in November because that was when they began to signal they might raise rates. They pulled forward, right? They pulled forward the end of the taper, the end of asset purchases into March. And it was really at that point that the market began to say, okay, we'll price in higher interest rates starting in March. And so, and that was the answer that Powell gave at Sintra last month when he was asked by the moderator, whether the Fed was being led by the markets. And he actually said, I think I have the quote today, he said, when people look back at the history of this cycle, they're going to see that, he said, we were able to have financial conditions tighten quite substantially, and we've only had 3 meetings at which we raised rates. So that's sort of the argument for forward guidance in a tightening cycle that, in this go around, the Fed has actually been able to tighten financial conditions. You really see it in the mortgage market. You had mortgage rates, touching 6% a month ago when the Fed did the first 75 basis point increase. And Charlie Evans, the Chicago Fed president, spoke about this in New York in mid-May as well. He said, look, if the chair had gone into the March meeting when inflation was at wherever it was then, 7-8%, and said, all right, we raised rates by 25 basis points, and there had been nothing else. There had been no press conference. There had been no dot plot. I think Evans basically said, gee, that would have been really hard, right? People would have said, what's wrong with you guys? Why aren't you doing more? But they were able to use sort of their suite of communications to tighten conditions without doing something that would be extremely disruptive. I think to get to your question now, the question now, I think at this meeting, and you've seen a number of analyst notes in the past few days, Goldman and JP Morgan saying, maybe the Fed's going to want to fuzz it up here and be less specific about the next meeting. Because again, in May, Powell went in and said the most likely outcome would be a 50 in June and July. That was, I think he said, that where the committee, the center of the committee was. But then they went and did 75 after the May CPI was hot a few days before the June meeting. And then again, as you noted, right before this meeting, before the blackout period began, a week ago, 2 weeks ago, you had another very hot, broad-based inflation report, the June CPI, and markets began to price in 100. And so, there are some people now, and I quote Bill English, the former director of the Monetary Affairs Division at the Fed, saying, maybe this isn't helpful anymore. Maybe it was helpful to kind of bracket some of the volatility. You still had a lot of volatility, obviously, but maybe you would have had more when you really kind of open up Pandora's box of, well, you could do 25, 50, 75, 100, who knows? I think the other question is, it's easier probably to do this when there's a clear consensus on the committee. And maybe that still exists for the September meeting. But as you think about the terminal rate and where the committee might want to have rates at the end of the year, I think you could begin to see more division. You have everybody in the June SEP projecting a rate above 3%. That was notable, right? Because you definitely didn't have that in the March SEP. But now you've heard people like Jim Bullard recently come out and say, yeah, I was in favor of getting to 3.5 by the end of the year, but now I think it's going to need to be 4. You've had other hawkish people like, Governor Bowman saying she wanted to do a 75 and then continue with 50s after that. But you could begin. We haven't really heard a whole lot of doves. There aren't a lot of doves right now. But as the economy slows and you see more threats to growth here, you have to wonder how much longer the consensus to keep doing big rate increases will hold.
Yeah, and I just want to really hone in on that point, is that the value of forward guidance is being able to tighten monetary conditions by letting the market know what you're likely going to do in the future rather than just tightening them now. So, in your article that came out early this morning, as you say, Powell noticed that bond yields, mortgage rates spreads have widened significantly more than they would if they were just starting that cycle. So if that's sort of the phase one of this cycle, why is it that we might be more inclined to sort of a 50-50-50, sort of a steady tightening of financial conditions? Because we're approaching the terminal rate pretty quick. I mean,
when you say 50-50-50, you're talking about 50 basis points September, November, December.
Yes.
Yeah, I mean, I don't know. I don't think they know. I don't know. I mean, here's an exercise. Go back to January, the January FOMC. And I tweeted, I think either before or after the meeting, I just went through all the analyst notes, what their Fed call was at that time. And I was looking at it the other day. It's very dated now. But almost everybody around then was saying 3 hikes this year, 4 hikes this year. You had B of A, Ethan Harris, way out on a limb saying 7 quarter. These were all quarter point hikes. Maybe Nomura had a half point increase in there. So, you go back and look at that now. 6 months ago, all the Fed watchers at all the big banks thought things would look, very different from where they are now. So I think it's really, trying to say where things are going to be 6 months ahead in this environment, it's just extremely difficult. And I'm not sure anybody can have a huge amount of confidence where the terminal rate is. I also go back to 2018, September of 2018. I remember being at a conference at the Boston Fed where a number of people, either former Fed policymakers like Roger Ferguson or very sharp outside analysts like Jan Hatzius at Goldman Sachs, were saying terminal rates higher. The Fed's going to have to do a lot more than they say they're going to have to do. People were talking about a terminal rate above 3%. And of course, the Fed did just one more rate increase after that at the December meeting. The market puked. The Fed pulled back. Inflation was defying the Fed's forecast of rising a little bit above 2%, and in fact was not up to 2%. So the Fed just called an end to it. Powell called an end to it there. So you go back to that cycle. People thought the Fed would have to do more, and the Fed didn't. Is it going to be like that again this time? Obviously, that's what the market thinks, but maybe everybody's going to be wrong again, the way they were at the end of January. And if inflation is stickier than the market expects, if it's more inertial, you've got this tailwind now from the shelter inflation, which is going to add, a half point to core PCE over the next year. I think 1.1 percentage points. This is an analysis from the San Francisco Fed a few months ago. I mean, the way the shelter inflation alone is calculated, it's very lagged. So if you're actually looking for monthly deceleration in the inflation prints, which is what someone like Governor Chris Waller has said he wants to see, 0.2 to 0.3. If you're going to be getting a lot of sticky inflation from shelter, then you're going to need even more deflation or disinflation from all of the things that people have been looking for: used cars, airfares, commodities. So we'll see. I mean, what if the market's wrong again and the terminal rate's closer to 4? I talked to a trader yesterday who said, I think the terminal rate's going to be above 5%. And so you've got a pretty wide distribution of probabilities here. Maybe, I don't know, maybe that's another reason to sort of fuzz up the forward guidance here, because, I think what Powell said in response to a question at the last press conference was, we'll see as we go, we'll learn as we go. And if they have to do more, they'll do more. And the real difficult questions, I think, start to arise as you see more slowdown in the growth numbers. But what if the inflation, numbers either lag or don't cooperate and continue to get worse? People want to know, of course, what the Fed's reaction function is in that situation. People ask me all the time. I'm not sure the committee even knows, because, the committee spent a lot of time during the framework review in 2018, 19, 20, looking at all these things for what do we do in the next downturn if we can't get inflation to our target. And so they really had a clear idea, I think, of how they would react. And then they reacted when the pandemic hit. But we haven't been in an environment with inflation this high. So you sort of can't be terribly confident that what the Fed did in the last 3 cycles, when inflation wasn't as high as it is right now, is exactly how they would react in this cycle.
Yes, and a lot of macroeconomists who look at forward-looking indicators like the housing or the yield curve inversion of the copper to gold ratio, that is not necessarily what the Federal Reserve is focusing on. They are focusing on the labor market, with the unemployment rate still at 3.6%, is very healthy. So Powell earlier in the year was noting that you could do a soft landing. Inflation could moderate, but unemployment would not materially rise. Maybe 5-6%, but not above then. But now suddenly Powell has been talking about a soft-ish landing. What do you think a soft-ish landing looks like?
Yeah, that's a great question. I asked him that in the May interview, and you'd have to think it's something close to a mild recession, maybe a technical recession. If you look at the June SEP, and one of the changes they actually made after the framework review, they used to release kind of supplemental materials to the SEP with the minutes, and now they release it with the SEP. So if you go to page 5 of the June SEP, you can actually see the distribution of participant projections for the change in real GDP. We get the median in that, that first chart. You get the median and the central tendency in the range, but you can actually see, and if you get out your ruler, you can count up the number of projections in each column for GDP or inflation. And what you see there is a good half of the committee, more than half in 22 and 23, saying GDP under appropriate policy is going to be below trend. And in some cases, significantly below trend. So for next year, you've got one person who wrote down GDP year end between 0.8 and 0.9. My point here is that a lot of people are saying you're going to need to have 2 years of GDP below trend. And they can't fine tune this, right? If you get, if you think you might get GDP at 1%, you could very easily slip down to 0 or negative. So what they're saying here is under appropriate policy, you will have the, growth below trend. You will have the unemployment rate rising. That could be as close to a projection of a recession. I don't know if you're ever going to get a projection of a recession in the SEP that, I'm sure I guess there could be scenarios where you see that, but I think it would be hard politically to just say, appropriate policy here is going to be a recession. So they may not project it, and this may be as close as you get. So I think, a softish landing would be consistent with a technical recession or a mild recession. And you're hearing that more. I mean, Powell talked about a soft landing in his March testimony to Congress. This was early March. The war in Ukraine had just begun. And he said, I think we have a better than even chance, something like that. He basically gave them, better than 50-50 chance of having a soft landing. To my knowledge, he has not said anything like that since then. He gave his NABE speech 5 days after the March FOMC meeting, where he said it would be difficult, but he thought, it was possible. And now when he talks about it, he never brings it up himself. He never says, this is what we're trying to do here. No, he's saying we're trying to restore price stability, and there's a plausible path to having a soft landing. And, it's almost aspirational at this point, but it's secondary to their goal of getting inflation down. Now, you do hear other Reserve Bank presidents like Jim Bullard saying that that's still his baseline. But the fact that you're not hearing that from the chair suggests that, that they may not be completely, convinced that this is the modal or baseline outlook at this point. We'll see. I'm sure he'll get asked about it at the press conference tomorrow.
Yes. How are you thinking about the real GDP figures? I believe the real GDP figures you just referred to in the SEP are year over year, whereas I know the
Q4,
whereas the Atlanta Fed projections is annualized quarter over quarter, and last quarter was negative real GDP. This one that's coming out on Thursday, I believe, from the BEA, that could be negative. I mean, I just look at the data, and the Atlanta Fed is rarely wrong by a sufficient margin to make it positive. I think the last reading was something like negative 1.5. So if we have two consecutive quarters of real GDP contraction, a lot of folks consider that a recession. I know the NBER may not consider that a recession, but how does the Federal Reserve think about it? How does the Treasury think about it?
Well, so we heard from Janet Yellen on Sunday. She was on Meet the Press, and she basically said, there are special factors. I mean, if you look at the first quarter, and Powell has already addressed this. I mean, if you look at private final demand, where you're taking out imports, you're taking out inventories, and you're looking at sort of the underlying strength of the consumer, that was a positive number. Now, it's been revised down since the last meeting, and so, but it's still consistent with sort of trend growth in the economy. So I don't think that there's a whole lot of there's not a lot to say about the Q1 report in terms of were we in a recession in January when we were still adding 400,000 jobs a month or 300 plus. In the second quarter is going to be interesting. It'll be interesting to see where consumption is. Obviously, the housing market, residential investment starting to weaken. But again, I mean, this is what the Fed wants to see right now. They want to slow the economy down. And so it shouldn't be, it'll be interesting to see what happens when you have negative employment reports. I think negative growth numbers, especially when you can kind of point to special factors, I'm not sure that there's as big of a story there. And go look at what Chris Waller has said recently. Governor Waller has been asked about this, and he's pointed to the discrepancy between GDP and GDI, gross domestic income. Over time, the two should basically, meet somewhere in the middle. And so he sort of suggested that maybe the GDP numbers are going to get revised up. Maybe there is more weakness there than you see in the gross domestic income numbers. But that's sort of something to keep your eye on is GDP versus GDI. And again, I think the more difficult questions happen when you actually see signs of contraction in or a real slowdown in personal consumption expenditures and private final demand actually slowing down a lot more than what we saw in the first quarter.
Right. But if there is a Fed pivot, when it happens, if it happens at all, will it likely be stress in the labor market that causes that pivot rather than some other piece of data that isn't related to the labor market?
Yeah, that's a great question. I don't know the answer, but I wouldn't expect to see. I mean, they've said they want to see a slowdown in inflation. So, if the growth numbers are saying something, but the inflation numbers are saying something different, then you have to at least pay attention to what they're saying they're paying attention to, which is inflation. Now, obviously, at some point, you have a forecast of inflation that maybe becomes relevant because you're seeing a lot more slow growth in real activity. And Waller alluded to that in his July 14th comments in Idaho. He basically suggested there was, something to keep an eye on there. But they're going to want to see actual slowdowns in inflation, in part because they were wrong-footed last year. I mean, if you go back to, a lot of people say, well, they should never have said transitory, and they certainly shouldn't have stuck to it as long as they did. But one of the reasons I think they did was when the Delta variant hit, you did see a slowdown in some of those categories that had surged. And so actually their initial thesis that, this is related to the reopening of the economy and it's being driven by pandemic, used cars, airfares, et cetera. And as you saw sort of the non-pandemic related items having less inflation in July and August of last year, they said, okay, see, we can take some comfort from that. Well, fool me once, shame on you, fool me twice, shame on me. So I think there's going to be an even higher bar there. But we don't know. It's a big committee now. You're at full strength with 12 people. You've got some new governors and new Boston Fed president at this meeting. We'll have a new Dallas Fed president, Lori Logan, at the next meeting. And so committee dynamics are, can kind of create their own forces. And I go back to this point I made before, which is we don't really understand their reaction function in a high inflation environment because we haven't been in one in a long time. And I'm not sure they do either. And so, that's got to be what they're working out right now as they go into this meeting.
Who would you say are the most dovish members, if there are any doves left, or the least hawkish members of the FOMC? And then who are the most hawkish who really want to lead the charge into, getting that effect, the Fed funds rate up?
That's another great question, Jack. And I say I don't know. I think some of these things have been turned on their head. I mean, at the beginning of the year, if you had like a Fed bingo card, a lot of people didn't have consecutive 75 basis point increases on it. They didn't have Esther George with a dovish dissent at least one meeting, and we'll see if she dissents again tomorrow. So, in the past, I mean, look at Esther George's voting record. She had a number of hawkish dissents 10 years ago. And now someone who you might point to as a quote unquote hawk is dissenting for dovish reasons. Then you have Minneapolis Fed President Neil Kashkari, who was constantly a dove and, dissenting, saying, why are we raising rates on a forecast of higher inflation? This was 5-6 years ago, and continuing to take that position up through the pandemic. He self-disclosed after the June SCP that he had the highest dot, at least for this year, next year, in the June SCP. So, if you'd asked me this 12 months ago, I would have said, Kashkari is a dove and George is a hawk. But if you're asking me today, I'd have a completely different answer. And so, so let's just go on what people have said publicly recently. I mean, Bowman has clearly laid out a marker that she wants, I think she said a 75 at this meeting. And that was when, the choice on the table was really between 50 and 75. And then she wanted to continue with 50s after that. Waller and Bullard have been on the hawkish end, obviously. And then you've had, I don't know that there are true doves when you're in an inflation environment like this, but you have heard from people like Charlie Evans, the Chicago Fed president, Pat Harker, the Philadelphia Fed president, maybe more eager, I think, to get back to 25s at some point. But still, it was notable when Charlie Evans came out a few weeks ago and said he thought 75 would be appropriate for this meeting. So there are no doves in inflation foxholes. And at some point, I imagine we will see more of a debate around, getting back to a quote unquote measured pace. But I do not see that, happening right now. And we'll have to see kind of where the Fed speak comes out as people communicate after this meeting. But the last inflation number was high. It was broad-based. Dallas Fed trim mean printing pretty high, I think 4.4% on a 6-month annualized basis. Very hard to point to things right now that would give you justification to be dovish, at least on the inflation side.
Yes, and that last reading, CPI, sort of the mainstream index, was at 9.1% year over year increase. PCE, which is what the Fed looks at, was at 6.3%. I know the Federal Reserve has issued a statement, and correct me if I'm using the wrong words, but they need to have a clear and compelling evidence that inflation is moderating before they start to ease policy or stop tightening policy. What do you think and compelling evidence?
Clear and compelling was sort of the threshold that Powell had laid out when they were doing 50s. And so he was saying to take things down to 25, they would want clear and compelling evidence. It's harder now, I think, to sort of, what do you need to step down from 75 to 50 and then from 50 to 25? That was really where 75 opened up more of a can of worms there. And Powell came out and said at the last meeting, they don't expect 75 to be common. So maybe that was a way of saying, we'll do one more of these and don't expect it to be, 75s until we get clear and compelling. But that is something that I think they're going to have to work through and communicate more. At least here you could say you couldn't do this 6 weeks ago, but now you can at least point to things that you would think would give them help on, at least on the headline inflation, right? Gas prices are down, commodity prices are down, core maybe not. This interesting wedge had opened up between core CPI and core PCE, almost 2-point difference between them, in part because of the different calculations around airfares in the CPI. Shelter takes up a bigger component of the CPI basket. But now actually you're moving into an environment where maybe core PCE you're going to close that gap with core PCE moving higher. That certainly seems likely for this report we're getting this week, if you look at the forecasts from some of the Wall Street shops. So yeah, it's going to be tricky to thread the needle here if you want to see clear and compelling evidence that core inflation is coming down. What do you do if you don't get that, but you do see more of a slowdown in the real economy? it'll be really interesting to see how the different policymakers kind of work through that sort of predicament.
Nick, a key theme for Fed Chair Powell was saying that financial conditions needed to be tighter. Now, I think the sort of mainstream interpretation of financial conditions, like something like the Goldman Sachs index, financial conditions index, is risk-free rates. So that's the Fed funds rate as well as the 10-year Treasury, credit spreads, as well as equity prices. So when Fed Chair Powell was saying that financial conditions need to be tighter, effectively, the message was stocks need to be lower, bond prices need to be lower, spreads need to be higher. We're doing our job on risk-free rates, but the market, you need to do your job. How much of that journey do you, first of all, do you agree with my interpretation? And secondly, how much of that journey of tightening of financial conditions needs to happen? If there, let's say there's a terminal Fed funds rate of 3.5% in December, that's how high the Fed needs to go to moderate inflation. How high do you think we are from a top in like credit spreads or equity prices?
Yeah, that's a great question. When I did an interview in April with, now she's the vice chair, Lael Brainerd, and I asked about kind of a neutral policy rate, and she sort of was talking about neutral financial conditions, which is a little bit different. And I have detected a desire on the part of at least some people on the FOMC to get away from talking about a neutral rate because their long run estimate of neutral is when inflation's at 2%, but inflation's not at 2% right now. So you have to, I think, take this estimate that neutral is between, the range is, I think, 2 to 3%. People say it's around, 2.5%, give or take, a quarter point. But, it's hard to have a lot of confidence in that in normal times. And it's even harder when underlying inflation has probably moved up. So Mary Daly, for example, said recently that, her estimate of neutral of a real neutral rate was about 0.5, but she thinks that underlying inflation has moved up to 2.6. So she thinks that a neutral rate would be closer to 3.1. Nominal neutral in the short run is closer to 3.1. So I think that there's been an emphasis by some people, including Brainerd, to look at, well, can we get to a neutral or then to tight financial conditions? And that's where you get into some of these interesting, maybe more arcane debates about, is it the level of the funds rate that matters, or is it this? Do you get any benefit from speed effects? I hear a lot of economists saying, no, there's no such thing as a speed effect. Raising rates faster doesn't actually tighten, doesn't get you to neutral faster. But I've heard some economists outside the Fed, Lou Crandall, at Rights and ICAP is one, who's basically said, no, I do think that there's such a thing as a speed effect, and you can achieve a neutral financial conditions or tight financial conditions depending on how quickly you move. And there may be some sign of that in the housing market. If you look at the housing market, I thought there was a good case earlier this year that you might see, the market able to handle a 5% or 5.25% rate, which had really began to slow down the housing market back in 2018. At the end of 2018, when we got there, you saw the builders beginning to say, all right, this is a completely different environment for us. If we had just stayed around 5.25, I think the housing market had more going for it this time in terms of pandemic-driven shifts in demand, much tighter inventories. But the speed with which we moved from the low fives to the high fives, and for a brief period there we were above 6, that takes people out of the market, and they just say, okay, hold on, I'm out. I'm going to wait. I'm going to step back here, and again, this is only one sector of the economy, but I do think it's one place where you can maybe test out this idea of a speed effect, that going from where we were at the end of last year, 3.25, and almost doubling the mortgage rate, sharp increase in the monthly payment. People buy their house. They sit down to decide what they're going to purchase based on that monthly nut. And when they've seen that it's gone up 40% or 50% from where that kitchen table discussion was back in December, that has an impact. Do they think that they've done enough on tightening financial conditions? Well, we're going to need to see it in the inflation data because that's the benchmark that they've laid out. And that, sort of gets into this idea, well, if the market's pricing in cuts now and you see long end yields coming down and financial conditions easing because of that, If the dollar were to weaken here, you get actually easier financial conditions because markets are pricing in a recession and a reaction function that implies the Fed cutting right away. Does that actually mean the Fed is now further from where it needs to be? And so the more the market prices in ease, does the Fed then say, all right, well, this isn't tight enough. The beatings will continue until morale improves. We're going to 4% on our terminal rate. We'll see. I think those are interesting questions ahead of us.
Yeah, I'm glad you mentioned the dollar because that's sort of the hidden element within financial conditions. Because as the dollar strengthens against other currencies, it can just diminish liquidity worldwide. So, how does the Federal Reserve think about the surge in the DXY, the U.S. dollar index? The euro was briefly at parity. The euro has been falling sharply against the dollar. The yen has been falling sharply against the dollar. Pretty much every currency has been falling against the dollar. Typically, the Fed can get very, very worried about that, as they did during March 2020, as you cover in your book, $1 Trillion Triage. They extended trillions of swap lines across the globe. But now the DXY is higher, much higher than it was in March of 2020. So, is there at some point that is the rising dollar in service of the Federal Reserve's goals to tighten inflation, and at what point does it become a threat to financial stability?
That's a great question. I mean, yeah, this is a completely different situation from say 2014. I think in 2014, you actually had Bill Dudley, the New York Fed president, out there saying, yeah, the dollar's gone up, I don't remember, 25%. And that's going to influence their ability to get inflation back up to 2%. Now, a strong dollar is helping them out. You're right. They don't want to have a market repair, a market crack up event. So I imagine at some point, you don't want things to get disorderly, but a stronger dollar is helping the Fed right now. You saw import prices last month, negative 0.5% on the month. I think that was the first negative reading since the pandemic. And, negative import prices, falling import prices are going to help the Fed here. So, this isn't a concern for them the way it was in March 2020 or, 2014, 2015, where the dollar was tightening financial conditions more than the Fed had wanted.
Nick, I've heard anecdotal reports of the members of the FOMC, as well as Fed Chair Powell himself, extremely resolved to not make the same mistakes of, let's say, Arthur Burns, who was the Fed chair president during the 1970s, who did not tighten monetary policy enough. Inflation became unanchored until the hero that we all know and love, Paul Volcker, raised rates, caused two recessions, but moderated inflation for decades to come. How accurate? So I hear that it's essentially gossip, but how, you're very well sourced. How accurate is that characterization?
Yeah, it depends on, I guess, on what the exact characterization is. But, there was this story that Randy Quarles, the former Fed vice chair, told at the Hoover conference in early May at Stanford. And just to relate it quickly to anybody who hasn't heard it, he was asked, or he was on a panel with Jim Bullard and Chris Waller, and they were all asked, if you need a 5.5% unemployment rate to get inflation down, will this committee do that? And Jim Bullard sort of, said, I think that's a question for Randy, because the current policymakers, that's a harder question to answer, right? Do you really want to say you think you need the unemployment rate to go up by 2 percentage points and however many millions of people to lose their jobs that entails? But Randy Quarles said, I'll answer that question and I'll tell you a story. And he explained that, he commuted between Washington, D.C. and Salt Lake City, where his family lived. His family had moved to D.C. when he was at the Treasury 20 years ago, and he didn't want to move him here again. So he would just spend the week in Washington, which meant he was able to work late into the night in the Eccles building. And he also explained that he had this habit of triggering a security alarm in his office that would send security officers into his office late at night, and they finally realized he just does this, so they stopped responding. But one night there was a security officer who was new or didn't know that Quarles kept hitting the button. So the security officer came running, and then Quarles went on to explain that he had some art on the walls, and this particular security officer was something of an art buff. And so Quarles was explaining some of the different works of art on the wall, and he said he had as a memento mori a painting by Arthur Burns. And he began to explain why, it would be sort of ironic for a Fed governor to put an Arthur Burns painting on the wall, but the security officer stopped him and said, I know who that guy is. He's the guy who let inflation get out of control. And everybody at the conference laughed. And then he went on to explain, you can be a Fed that causes recessions and people may not remember you. Every Fed chair, except maybe for Janet Yellen, has had to deal with a recession. But if you're the person who doesn't keep a lid on inflation, and we've all agreed now is sort of the way that this economic system we have has been structured, the Fed is in charge of inflation. The whole reason people talk about or maybe fetishize Fed independence is because you want the Fed to be able to do what they need to do if inflation gets out of control. And so Quarles said, so the answer to your question, would the Fed permit 5.5% unemployment rate if that was what it took to get inflation? And he said, yes. And it's because people don't want to be, remembered. Chair Powell in particular doesn't want to be remembered as sort of the second coming of Arthur Burns. Now, there are other people who are worried that maybe that, if you make sure, I think as we saw last year, the Fed was so focused on not repeating the mistakes of 2008, 9, 10, 11, 12. And so they went all in, don't pull back your tools until it's clear that you've got the economy going. And they didn't make the mistakes of 2008, 9, and 10. They made new mistakes. And so again, if you try to fight the war of, the 70s, obviously there's a risk you're going to make completely new mistakes. And then, 2 or 3 years from now, you and I will be talking about, well, shouldn't they have stopped sooner or shouldn't? And you kind of get into that parlor game that academics call counterfactuals, right? The what if game. Well, what if, the Fed had raised rates a ton in 2004 and 5 and avoided a housing bubble, right? You'll never know. And so that's, I think, sort of the situation that people are going to find themselves in right now. You know what the mistakes were that you made in the past, so you can try to make sure you don't do, say, the stop-go policy. People talk about, the Fed pause here is sort of, Larry Summers, for example, is talking about the Fed can't pause when they normally would, because then you won't actually slay the inflation dragon. And the recession in 1974, 75, where Burns eased, inflation came down from, say, 10% to 6%, but then it started to go up again. Obviously, you wouldn't want to get into a similar situation there. Don Cohn, who was a Fed lifer and ended his service as vice chair to Ben Bernanke, made a different point to me recently, and he made this point at a conference at the Dallas Fed last month, where he said, look, there was the Volcker moment that everybody talks about in 79 and 81, changing the operating regime, targeting the money supply, raising rates to much higher levels than he had anticipated they would go to bring down inflation. But then there was a second Volcker moment in the summer of 1982, where that same monetary aggregate targeting regime would have called for staying tight, and inflation was coming down. It had come down a lot, but it was still at 5%. And he said, all right, that's enough. You were at that point looking at losing, part of the Southern Hemisphere and bringing down big US banks with exposure to Latin America. And so Volcker called time and said, we've done enough. And then actually the Fed did start to raise interest rates again in May of 1983, through the rest of the year. And so people don't talk about that as stop go, because obviously by then the Fed had done enough and you just had 4% inflation for the rest of the decade. So they're going to have to feel their way here, and history can provide some useful guides. But, the situation, you could make good arguments that the situation we're in today is a lot like the situation in the 1970s, where you had oil shocks and bad luck. You had a drought, high crop prices in 72, 73. But you could also argue that the structure of the economy is different, and that would call for a different response. And we'll see.
I think it's a perfect transition to talk about inflation expectations. That's not what inflation actually is, but what do people think it's going to be? Both the market inflation break-even rate, but also, perhaps more importantly, the consumer expectations of inflation. I believe the last June FOMC meeting, not only was it a high inflation reading, but also was a Michigan consumer survey that indicated that consumers' expectations of inflation were going up, and that was what occasioned the 75 basis point rise instead of the 50 basis point rise. Is that what people? Is that what is meant by Fed credibility? Because in your last the FOMC meeting, you asked Jay Powell about credibility. Is that what you mean? The ability to constrain inflation expectations, or does credibility mean something different?
Yeah, no, that's a great question. So, my question there at the June meeting was really about they had laid out a whole strategy for how they were going to conduct policy, which was really 50s until inflation comes down. And they had communicated that very unusually precisely, right? It wasn't just Powell, it was everybody on the FOMC. And then they did something different at that meeting. And so the question there was, you had to weigh the cost of potentially undermining your guidance by wrong footing the market when you had given a very precise guidance or a steer. And so the cost, that was really the question, was about the cost of making your guidance less credible versus the cost of falling further behind the curve. If you thought you were behind the curve and falling even farther behind it, clearly that was the calculus that they made there, that Powell made at that meeting was, he talked about how if you thought maybe you were going to do 75 at some point in the future, well, why wasn't that the right decision to do then? Why, they had sort of fallen into this position where they were doing the more conservative thing, right? In March, they could have done 50, but the war in Ukraine had just started. They hadn't done liftoff yet, so they did 25. And then, right after that, Powell goes out and gives a more hawkish speech saying maybe we're going to do 50s. The same thing I think had happened in November, where Powell, in the December meeting, when they accelerated the taper, he'd said, the ECI came out before that November meeting was very hot. He had sort of begun to think maybe we should accelerate the taper, but they didn't do it. And then the data broke hard in their face in November, and they changed. So, that was the question I was getting at the June meeting. Now, I hear a lot that the Fed lacks credibility in the markets, right? You hear that all the time right now. And I always am sort of confused about what people mean when they say that, because one interpretation is that the market actually doesn't think the Fed is going to do what's necessary to bring inflation down. To me, when people say the Fed lacks credibility in the market, that's how I interpret it. But if you look at market-based inflation measures, and maybe they're entirely wrong, they sure were 1 year ago, but the market right now has brought down substantially their expectations of where CPI is 12 months ahead. So the market now expects CPI, this is from ICE Benchmark Administration, to end the year around 7%. That's down from about 7.4% a month ago. 1 year ago, the market thought CPI would end this year at 2.4%. And the market now thinks CPI will end 2023 at 2.8%. So the market there is saying that they think one way or another, whether it's a Fed policy error, whether it's a recession, whether it's a steep Phillips curve, whether it's the supply chain completely, fixing itself here, they think we're going to get lower inflation, and not just a little bit lower inflation, but a lot lower inflation a year from now. Again, if those measures based off of tips and swaps are accurate. So I think the other answer is when people say the Fed has lost credibility, they're just talking about sort of forecast reputational credibility. But that to me is completely, it's an important point, but it's a separate point, because if a central bank has lost credibility and because inflation's high, then wouldn't you expect to see, a situation where the Fed turns more hawkish and the market prices in still higher inflation into the future, right? That's sort of what we saw maybe around the May meeting, but we haven't seen it since then. And so, I think there are different types of credibility. and it's helpful for people to talk about what they mean when they talk about credibility. You can have, your guidance not being credible because you said you were going to do 25 and you did 50, like what happened with the ECB last week, or you said you were going to do 50 and you did 75. But I think also if you do that every single time, then your guidance will obviously be less credible. It'll be useless at a certain point. So maybe the lesson there is do that only when you think it's an emergency, and and you don't do it after every hot CPI print, for example, which was sort of, I think, the message we heard from Chris Waller 2 weeks ago.
And guidance does not just refer to the dot plot; it's also the statements of senior Fed officials.
Yeah, there's a suite of communications. The dot plot. There's a lot of opinions about that, and whether it's more helpful than not, especially when you're conditioning it on a modal outlook. And what if there's a big distribution of potential outcomes, but you're really only showing what your reaction function is under one, and then you add to that you've got up to 19 people that could have different modal outlooks, and so they're putting together their own. It's an imperfect tool, and we've never had it in an environment of sort of the extreme high inflation that we have right now. So it's we're sort of testing it a little bit in the same way that if you think back 3 years ago, this was the meeting where the Fed cut, and we had never been through at that point having a SEP where you were going into a cutting cycle. There was a question, I think, at that June 2019 meeting: can the Fed even project cuts in the SEP, or if you think you're going to need to cut, do you just cut? There are more ways for them to communicate, and that can make it more complicated at times, and it can help them as Charlie Evans, again, as he argued it had in March. It allowed them to project a lot more tightening ahead of their action. But you do get into, all of the analysts sort of saying, well, what does this mean? Why are you doing this?
Nick, I know there have been instances where the Fed has cut rates in between FOMC meetings just because there's not enough time, most notably in March of 2020. Some people I've seen speculate, and I don't know how much credence I give this, that the Federal Reserve will do an emergency rate hike. How are you weighing this possibility? Is this something that is even being talked about at the Fed?
I mean, look, I guess you can never say never, especially after the year that we've had. But I don't understand. I don't understand the rationale for an intermeeting hike. If the Fed chair comes out and says we're going to hike a lot at our next meeting, then the market prices it in, and haven't you basically accomplished the point of the intermeeting cut? I don't. Maybe there's a scenario where if there was some sort of disaster unfolding in currency markets. I don't know. If you have ideas, email me about a situation where an intermeeting cut. I guess the question I would have, though, is what's the difference between the Fed chair just giving a speech where you get the market to say, okay, well, this is what the Fed's going to do, in 4 weeks or 5. You have a meeting every 6, 7, or 8 weeks. The reason why there's an asymmetry, there is a definite policy asymmetry there, right? They can cut, they can ease without telling people in advance, and you can take the market by surprise. And part of that, I think, is because, there is a desire to not completely interrupt or impair market functioning, right? And you don't have to worry about that if you cut, and then there's a surprise cut. There's also an argument that sometimes you can't wait to cut because things are so intense. And, I remember, and I write about this in $1 Trillion Triage. There were people that weekend on March 15th saying, you can't wait another day. They can't wait another day. You're going to begin to have, like a lot of breaking glass, metal crunching on metal here, and eating the seed corn, all the analogies. And so the Fed does, those sorts of emergencies will do emergency cuts. And I'm young. Maybe there's some scenario I haven't thought of where an intermeeting hike would be would accomplish something that the Fed chair going out and giving a speech saying, we'll hike a lot at our next meeting wouldn't accomplish. But I haven't yet encountered sort of the right example. I think where I hear that more is just from people who think the Fed is so ridiculously behind the curve. How can they not be getting rates up to 4% right now when they need to be there? But I think that's somewhat of a different issue. That's more an objection with the underlying policy than with the tactics.
Right. In which case, the Fed could just forward guide, say we're going to do 100 basis points for the next 3 meetings or something like that. Nick, it's been an hour. I'm only going to have a few more minutes left with you, but I'd like to ask you about the balance sheet. We've been talking so much about rates, so much focus is on that, but the fact of the matter is the Federal Reserve's balance sheet is shrinking with billions of treasuries and mortgage-backed securities rolling off, not selling, but rolling off from the balance sheet. How is the Federal Reserve, there's not a lot of news because it just sort of happens, but how is the Federal Reserve thinking about the process? Is balance sheet roll-off achieving its goals? Is there any chance that there would be a ramp up? I know we're not quite there to the $95 billion roll-up. So yeah, so tell us about that, and then also any particular news you'll have your eye on for tomorrow?
Yeah, the balance sheet policy. I mean, if you listen to what they've said about it, Powell got in trouble, I guess, in December of 2018 when he said it was an automatic pilot. So maybe they'll come up with a different word now. Maybe it's on cruise control. But that is, I think, how they think about it. That is how they've communicated their own view of it. They see it as a secondary tool. Charlie Evans, again, he made this comment somewhere recently where he said, forward guidance and the balance sheet, they're talked about as tools that the Fed has, but they're all in service of the primary tool, right? You're rowing. I think the way to think about this is they always need to be working in the same direction. So either your tightening policy and all of your tools are moving in that way. You either don't use forward guidance, when you're raising rates because you no longer need it, or you're using it to tighten policy, to communicate tighter policies coming. And the balance sheet, they've treated it the same way. So until they change their order of operations, and I've heard nothing from any of the comments that anybody has made publicly to suggest that they are thinking about using the balance sheet differently. I mean, the only, I think, live issue out there in the future for the balance sheet is that they haven't really answered is MBS sales, right? They've said that they would consider doing that, but they've made it seem like that's not a decision for this year. That would be something they would do later. They would be doing that not to achieve some sort of tighter policy outcome, but because they want to speed the composition towards a mostly treasuries portfolio faster. So aside from that, I know there are questions right now about how the Fed would react. Well, what does the Fed do if they get into a situation where they are cutting? And what does that mean for the balance sheet? And we have, a limited number of samples, really one, which is what they did in July of 2019. It was 3 years ago at this meeting that they cut. That was the beginning of the 325 basis point, quote unquote, mid-cycle adjustment. I mean, we don't know if it was mid-cycle. If there had been no pandemic, maybe it would have been mid-cycle. We'll never know. But they stopped the balance sheet runoff at that meeting. I believe that they were already on track to end the runoff later that year. I think maybe it was September. I'd have to check. But anyway, they said, well, we're cutting, so we're stopping the balance sheet runoff. Until they say otherwise, I think that, that's the inference you would have to take, is that that's how they would act again. But I agree, it's a good question to put in front of these people to understand whether that reaction function has changed.
Right. Again, we don't know which order, but the first thing is going to be cutting rates. There's not going to be an environment in which rates continue to go up, but QT stops. I'm sure you can come up with scenarios where, there could be technical reasons why they would do one and not the other. But as they've articulated sort of their reaction function, that's been their order of operations, right? Has been, first of all, your tools move in the same direction at the same time. Now, they've said maybe that, if there's some unforeseen, you think about what happened in the repo market in September 2019, where they were actually
increasing their balance sheet after that to add reserves because they concluded they had taken too many out of the market. Are there sort of scenarios like that? Of course, this time you do have the standing repo facility, which some people have argued gives them maybe more room or less concern that they would go too far in terms of running down reserves. But if you just look at how they did things last time, that was what they did last time. They stopped raising rates in January 2019 was when Powell said, we'll pause. And then I think it was at the March meeting that it was either January or March where they also decided that they were going to run an ample reserves regime. So at that point, they hadn't decided really, for all intents and purposes, they had sort of acted that way, but they formally announced we're in an ample reserves regime. So we'll end with a higher balance sheet. And that would allow us to slow the pace at which we're allowing assets to run off. They did that at the March meeting. So I think it was from March to September, they were planning to slow the runoff of the asset portfolio. And then they prematurely, by 1 month or 2 months in July of 2019, said, all right, we're gonna hold the balance sheet here now. It's possible they were still letting mortgages run off after that because they wanted to have an all treasuries portfolio. I'd have to check.
Nick, what do you think are there going to be the most important pieces of news that we're going to get clarity on tomorrow? Sort of as you're writing and taking notes as Fed Chair Powell will be speaking tomorrow, and you'll eventually ask him a question. What are the things that you're going to be paying a special attention to?
Well, it's like I wrote in my story today. I think the big question really is on what do they signal for the next meeting? Do they signal anything? Because at the last two meetings, he's basically walked in there and said, for the next meeting, here's what's on the table. So does he do that again? Obviously, people care about that. And I wrote about that today. And there are reasons to think that that's the strategy that's worked so far. There's reasons to think that maybe there's less of a passing the cost benefit test once you've got rates up this high. Once you're at least closer to neutral, even if you're not at neutral. If you do 75 tomorrow, obviously people have a lot of questions about the terminal rate and the reaction function for cutting. When do the cuts come? And I don't know how much clarity you get on these things that are still always, if you're still talking about raising rates to between 3% and 4% this year, and you're at 2.25%, I don't know how much. They're talking about these other things. What do you do after that? But I'm sure people will ask those questions, and we'll see how much the committee over the next couple of weeks is prepared to talk about those things.
We will. Nick, it's been a total pleasure having you on Forward Guidance. Thank you so much. Thank you, everyone, for watching the FOMC meeting tomorrow. Definitely will be something to watch. You should follow Nick Timiraos on Twitter at Nick Timiraos, Timiraos. Definitely check out his book, $1 Trillion Triage. I loved it. You're going to love it. And also, if you have the Wall Street Journal app, there's a button you can press to so you can get a notification for every single story, as I did this morning. Nick, thank you so much.
Thanks for having me, Jack.
There is something that you need to be doing right now, and that is reading the Blockworks Daily newsletter. For top market insights and the latest in crypto news, you have to subscribe to the Blockworks Daily newsletter, and you can do so by clicking on the link in the description to this video or by visiting blockworks.co/newsletter.